Diving into the stock market, what's the big deal? The stock market might seem like a mysterious place, but it's simpler than you think. Imagine a giant shop where pieces of companies are bought and sold every day. These pieces are called stocks, and when you buy a stock, you're essentially buying a tiny slice of ownership in that company. Pretty cool, right? Now, why would you want to own a part of a company? Well, as the company grows and becomes more profitable, the value of your stock also increases. This means you could potentially sell your stock for a higher price than you bought it for, making a profit. It's like planting a seed that grows into a money tree. But wait, there's more. Some companies also share their profits with stockholders by paying out dividends. It's like getting a little bonus just for being a part owner. The more shares you own, the bigger your slice of the pie. However, it's important to remember that the stock market is not a guaranteed get-rich-quick scheme. Just like any investment, there are risks involved, and the value of your stocks can go down as well as up. We'll delve deeper into these risks later on. So, you're interested in dipping your toes into the stock market. Great. But how do you actually buy and sell these stocks? Don't worry, it's not as complicated as you might think. The first step is to open a brokerage account. Think of a brokerage account like a regular bank account, but instead of holding your cash, it holds your stocks. You can open a brokerage account online or through a financial advisor. Once you have a brokerage account, you can start buying and selling stocks through a stockbroker. In today's digital age, most stockbrokers operate online, making it super convenient to trade from the comfort of your own home. You can simply log into your account, choose the stocks you want to buy or sell, and place your order with a few clicks. When you buy a stock, you're essentially buying it from another investor who wants to sell it. The price at which the stock is bought and sold is determined by supply and demand. If more people want to buy a stock than sell it, the price will go up. Conversely, if more people want to sell a stock than buy it, the price will go down. It's like an auction where everyone is trying to get the best deal. Now you might be wondering, where do all these stock buyers and sellers come together? Well, that's where stock exchanges come in. Stock exchanges are like giant marketplaces where stocks are traded. They act as intermediaries, connecting buyers and sellers from all over the world. Some of the most famous stock exchanges include the New York Stock Exchange, NYSE, and the NASDAQ. These exchanges have strict listing requirements, and only companies that meet their criteria are allowed to have their stocks traded on their platforms. Think of it like an exclusive club for publicly traded companies. The NYSE is known for its traditional floor trading, where brokers physically meet and make deals on behalf of their clients. It's a bustling scene straight out of a Hollywood movie. On the other hand, the NASDAQ is a fully electronic exchange where all trading is done through computers and networks. No matter the exchange, the basic principle remains the same: to facilitate the buying and selling of stocks between investors. Section 4. A company's journey from private to public. But how do companies actually get their stocks listed on these prestigious exchanges in the first place? Well, it all starts with an initial public offering, or IPO. An IPO is like a company's grand debut on the stock market. When a company goes public, it sells a portion of its ownership to the public in the form of stock. This allows the company to raise capital for expansion, research and development, or to pay off debts. It's like inviting investors to become part of their success story. Before an IPO, a company is considered private, meaning its shares are not available to the general public. Only a select group of investors, such as venture capitalists or angel investors, can invest in private companies. However, once a company goes public, anyone with a brokerage account can buy its stock. Going public is a major milestone for any company. It's a sign of growth, maturity, and a willingness to open its doors to the world. Section 5. The stock market's impact: fueling economic growth. The stock market plays a vital role in the economy. It acts as a barometer of economic health, reflecting investor sentiment and expectations for the future. When the stock market is doing well, it's generally a sign that the economy is growing and businesses are thriving. A booming stock market can lead to a virtuous cycle of economic growth. As stock prices rise, investors feel wealthier and more confident, leading to increased consumer spending. This in turn boosts business profits and encourages companies to invest and hire more workers, further fueling economic expansion. Moreover, the stock market provides companies with access to capital, allowing them to grow and innovate. By issuing stock, companies can raise funds to develop new products, expand into new markets, or acquire other businesses. This constant flow of capital is essential for economic progress and job creation. In short, a healthy stock market is crucial for a thriving economy. It's a symbiotic relationship where investors and businesses alike benefit from each other's success. Section 6. Taking the plunge. Tips for beginner investors. Now that you have a better understanding of the stock market, you might be itching to start investing. Here are a few basic tips for beginner investors. 1. Do your research. Before investing, learn about the company and its financial performance. 2. Start small. Begin with an amount you're comfortable losing. 3. Diversify your portfolio. Spread investments across different sectors. 4. Think long-term. The stock market requires patience. 5. Seek professional advice if needed. Section 7. Understanding the risks. Navigating market volatility. While the stock market offers tremendous potential for growth, it's crucial to remember that investments come with inherent risks. The value of your investments can fluctuate, and there's always a chance that you could lose money. Market volatility is a fact of life in the stock market. Stock prices can go up and down due to a variety of factors, such as economic news, company performance, geopolitical events, and even investor sentiment. It's important to be prepared for these fluctuations and not let emotions dictate your investment decisions. Before investing, it's crucial to assess your risk tolerance, which is the amount of risk you're comfortable taking with your money. If you're risk-averse, you might want to consider investing in more conservative assets, such as bonds. On the other hand, if you're comfortable with higher risk, you might be more inclined to invest in growth stocks or emerging markets. Remember, investing in the stock market is a marathon.